When people think of real estate investing, they usually picture apartment buildings or fix and flips. But some of the world's wealthiest investors are betting on something much simpler: the dirt beneath our feet. Today, we're looking at why farmland is becoming a powerhouse in alternative investing. Using a real-world case study of an offering for Ardoch Farm in North Dakota, we'll analyze the merits, the math, and the risks you need to know before you buy in. Farmland is unique. Unlike residential real estate, it is a triple-threat asset. You get potential capital appreciation as land values rise, annual cash flow from rent, and a natural hedge against inflation. In our case study of Ardoch Farm, a 157-acre property in the fertile Red River Valley, the strategy is clear. This region produces a massive portion of the United States sugar beet crop and is famous for its nutrient-rich soil. When you invest in high-quality land, you aren't just buying dirt, you're buying a critical part of the global food supply chain. Let's look at the numbers. This specific offering, AcreTrader 261, sought to raise $981,000 to acquire the property. It is structured as a sale-leaseback. This means the seller stays on as the tenant, paying a base rent of $200 per acre. For the investor, this is a major merit. You have an experienced operator already in place who knows the land intimately. Plus, the entry price was analyzed to be below market compared to similar sales in the region, providing an immediate margin of safety. Before you jump in, there are 3 things every investor must understand. First, many of these deals are for accredited investors only, meaning there are specific income or net worth requirements. Second, farmland is a long-term play. Ardoch Farm, for example, has an anticipated hold period of 5 to 10 years. This is an illiquid investment. You cannot simply sell your units like a stock on an exchange. Finally, watch the fees. In this deal, there is an annual management fee of 0.75% and a disposition fee of up to 5% when the farm is eventually sold. You need to ensure the potential returns outweigh these costs. No investment is without risk. In farmland, you are at the mercy of Mother Nature and global commodity prices. If corn or soybean prices drop, or if a drought hits, your tenant's ability to pay rent could be impacted. However, our case study shows a key mitigant: crop optionality. Because this land can grow corn, wheat, soybeans, potatoes, and sugar beets, the operator can pivot based on what the market demands. Also, the farm is pattern tiled for drainage, which helps protect against excess moisture, a common issue in the North Dakota region. Farmland can be a fantastic way to diversify, but it requires patience and a sharp eye for the details in the Private Placement Memorandum. If you found this case study helpful, hit that like button and subscribe for more deep dives into alternative assets. See you in the next one.